Today, we are going to look at a hypothetical situation and ask whether it is feasible to contribute to the plan, wait 10 years to avoid repayment penalties, withdraw the total amount, and then start over with a new account. The most critical rule to understand is the 10-year holdback period, also known as the Assistance Holdback Amount. This rule states that for every $1 you withdraw from a plan, you must repay $3 of government grants and bonds received in the 10 years preceding that withdrawal. To withdraw your funds without losing a single penny of government support, the plan must go a full decade without receiving any new government grants or bonds before taking the money out. Even if you successfully wait out that 10-year period, the strategy encounters three major financial hurdles that often make it a poor decision. First, the lifetime limits for the plan are permanent. You are allowed a maximum of $70,000 in grants and $200,000 in personal contributions over the entire life of the beneficiary. Closing an account and opening a new one does not reset these totals, meaning you cannot use this method to get more government money than you were already entitled to. Regarding the legality of this move, while the federal government does allow you to close a plan and open a new one later, you can only have one active plan at any given time. Second, the government stops providing grants and bonds at the end of the year the beneficiary turns 49. If you spend 10 years waiting to withdraw funds in your 30s or 40s, you may find that you have run out of time to attract new grants in your second account. Third, we must consider the impact of taxation and lost growth. When you withdraw funds from a plan, every dollar of government grant and investment growth is taxed as income to the beneficiary. By pulling the money out in a large lump sum, you potentially push the beneficiary into a higher tax bracket and, more importantly, you remove that capital from a tax-sheltered environment where it could have continued to compound for decades. To see why this is mathematically a poor decision, let us compare two individuals, each starting with a $50,000 registered disability savings plan, consisting of $12,000 in personal contributions, $28,000 in government grants, and $10,000 in accumulated growth. The first person chooses to use the plan as intended, contributing $1,500 every year at the end of the year to attract the maximum $3,500 in matching grants. Over the next 10 years, this individual adds $50,000 in new capital to their plan, representing $15,000 of their own money and $35,000 in government grants, while their existing balance continues to compound. Assuming a 5% annual return, after 10 years, this person would achieve an account balance of approximately $144,334, leaving them with a tax-sheltered asset. The second person decides to pursue the withdrawal strategy and freezes all account activity for 10 years to wait out the holdback rule. While their original $50,000 also grows at 5% to reach $81,445, they forfeit $35,000 in potential new government grants by stopping their contributions. When they fully liquidate the account at the end of 10 years, only their original $12,000 contribution escapes untouched. The remaining $69,445 in grants and total investment growth is taxed as a lump sum to the beneficiary. If this beneficiary has a modest base income of $15,000, this sudden spike triggers an immediate incremental tax bill of roughly $15,000 across most of Canada, which rises to approximately $17,000 for a resident of Quebec, even after factoring in the protective cushion of the disability tax credit. This leaves the person with about $66,445 in cash, or roughly $64,445 if they live in Quebec. Depending on where the beneficiary lives, this sudden rush of cash and taxable income can also temporarily reduce or completely suspend their provincial disability benefits, creating an unintended financial penalty. If they open a new account to restart the process, their lifetime grant room remains permanently reduced by the $28,000 they already claimed, and they have lost a decade of compound momentum, leaving them with roughly $77,889 less total net wealth than the person who simply stayed the course. Catching up to the first person under identical market conditions is mathematically nearly impossible because a lifetime grant ceiling of $70,000 applies across all accounts combined, and the lost decade of tax-sheltered compounding cannot be recovered. The rules regarding this strategy are consistent across Canada because the Registered Disability Savings Plan is a federal program governed by the Income Tax Act. There is no provincial variation in how the 10-year holdback, the lifetime grant limits, or the taxability of withdrawals are calculated. Where the provinces do differ is in how they treat the withdrawal as it relates to provincial disability benefits. In provinces like Ontario, British Columbia, and Alberta, the assets and the income from the plan are fully exempt, meaning a large withdrawal will not disqualify you from receiving provincial support. However, in other jurisdictions, you must be careful, as a massive lump sum withdrawal might be treated as income or liquid assets that could temporarily impact your eligibility for other social programs. Ultimately, treating the plan as a revolving door is an inefficient way to manage wealth because it forces you to abandon 10 years of guaranteed government matching and subjects your life savings to a high-tax event that could have been avoided by taking smaller, planned payments after the age of 60. The math proves that the most effective way to utilize this tool is to keep the capital within the tax-sheltered environment for as long as possible. If you have any specific questions regarding how these rules apply to your unique financial situation, please contact me by email to discuss this further.